Welcome, everyone. I am Lauren Cadillac with Cadillac Law, and today we are talking in our multi-part series about real estate investing. I have brought back my special guest, Dan Fradenburgh, and Dan and I, as you may recall, are talking about multifamily investments. Dan talked to us about, in our last video about syndicating in terms of a large multifamily deal. And Dan, I really thank you for coming back today.
Definitely my pleasure.
All right. As always, everyone, nothing said here is actual legal advice. We're not creating an attorney-client relationship between you or my firm. This is just knowledge. This is things Dan have picked up, things I have picked up. We're just trying to help you on your real estate investment journey. So, Dan, we talked last time about a syndicate and how you can be a limited partner. You know, if you have $100,000, you can go and invest in these syndicates. It's a great real estate investment, and a limited partner is nice and easy because you don't have to do a whole lot. Well, what should someone do? They haven't found a syndicate necessarily, but they are wanting to go find some buildings, or maybe they even know someone who wants to sell their apartment building. Where do they begin? Where's our first stop?
That's awesome. Many people do start off as a limited partner where you're not allowed to do any of the work. A general partner will be one of the people who are responsible for the ongoing day-to-day operations of the apartment complex. But when it comes to where to start, it depends. Some people like to get a piece of ownership of one of these buildings first, because that allows you to ask the people who are running it all of your questions, and you can skip a lot of the step of getting a coach. A lot of people end up using money that could be used for investment when instead they could they get this training and they have nothing to show for it, and they still have to pony up if they're going to get a piece of anything. But the big thing I see, especially right now, I won't mention the date just in case it's not so good, but we went in the last year or so from anybody who could fog a mirror being eligible for the loan to right now, a lot of deals are getting delayed in their closing because one thing or another, the interest rates going up or something like that. So the piece of advice that I'd want to do is reach out to some mortgage brokers, talk to the people who actually lend the money, and then find out what sort of numbers you're eligible for with your GP team.
What is GPT, Dan?
Okay, so the GP team, that's the team of owners who are general partners, and they're running the actual business. So you're not going to be able to do the whole thing by yourself. It'll end up being the only thing you do, and you're not going to be able to, take over a second property and a third property and a fourth and so on. So that's basically the thing you have to be concerned about. But with your team that you're going to be cooperating with to take ownership of these properties, you need to find out what sort of lending is available to you in the areas that you want to focus on. I'd go deeper on how to find a good target market, but maybe that's better for a next one.
Well, so you put together your GP team, right? And then you go find a lender, to find someone who's going to be willing to give you money. And are they giving you money just based off y'all's resume, or?
So there are a few parts of it. One is the guarantors, which are the general partners. They're going to have a combined net worth of at least the amount of the loan. It actually has to be pennies or like $1 more. Apparently, it's not that important, but you must have a net worth exceeding the amount of the loan size that you want. But the things that are going to change is some lenders will give you a loan equal to a certain percent of the cost that you picked it up for. Others will give you a loan based on the value after you finish making your improvements, which are pretty typical in commercial real estate. It's competitive enough and people are leveraged enough with their loans that you're going to need, like in most cases, you're going to need to make some improvements in order to make it especially profitable for your investors.
Awesome. I understand that. So the idea is you have the apartment very much like a fix and flip, right? Like
Mhm.
you have the complex and then you go in and you do some remodeling and you add value, right? And
Mhm.
now your equity increases the same way it would have if you were doing a fix and flip. Is that what you're
Right.
saying?
Yeah, that's right. And the read between the lines that's extremely difficult to decode is when people are not so well to do, maybe their investor network isn't that big, they're going to really depend on doing the fix up part of the flip.
Mm-hmm.
Whereas those who have very, very deep pockets, they're going to be attracted more to stabilized assets. So that would be something where it's already, over 90% occupied, and it has been for at least 3 months. So some people are just looking for cash flow and they don't want to have any downtime while contractors are fixing up the different units to make it a more profitable business. So they're more attracted to something that doesn't need any fixing up. So it's a different kind of investor will look for those two different sides, either stabilized or a value add fix and flip.
Ah, interesting. And so I think that would, if someone is starting in this business, and particularly, if you're a real estate investor that's already done fix and flip, you're probably going to want to transition to the fix and flip starting out to build that cash basis so that eventually you can get to the steady investment side.
Yeah, because you need to create that margin. Because I have so much experience in different retail types of businesses, that's the part that I'm always laser focused on. It's like, what exactly is the play? And in these cases, they're creating margin. And I think to understand the play, you just have to think about fantastically wealthy people and what are they going to want to do. So if you have basically all the money in the world, what do you actually want? Well, you want to have an income stream. You can just go ahead and buy the building full out because you're so loaded. But the thing
Mm-hmm.
is, with inflation, all your money is losing value all day, every day. So they're saying, okay, well, I want to dump it into an apartment complex because it holds its value because inflation brings the price up. But I
Mm-hmm.
also get cash coming in. And that's so when you get that kind of cash flow, that passive cash flow, a lot of people take that as guilt-free money. So if you're actually working for your money, then you got to be really careful about saving it. Whereas you build your passive income so you can just blow it on whatever you want is kind of the play.
Absolutely. That's why I'm looking for passive income because,
Yeah.
I like shoes. Well, Dan, I really appreciate that. And I think this has been a great talk. We are going to have several more videos in this series, and you will be guest starring in some of those for us. So I hope everyone has learned something. Make sure you hit like and subscribe, and don't forget to come back for our next in the series about real estate investing. Thank you.